Hello and welcome back to Eurosceptic TV. At its latest ECB meeting, the central bank opted to cut its main refinancing rate from 0.25% to 0.15% and implemented negative deposit rates. Here to give us a little bit more insight into this and share his no doubt controversial thoughts, it's Dr. Frank Hollenbeck. Frank, thank you very much for coming in today.
Hello, Natalie.
Now, in addition to, as I mentioned, the refinancing rate, the negative deposit rates, it also hinted at a form of QE where the central bank will purchase asset-backed securities and possible government bonds later in the year. Give it to us. What do you think?
Well, by trying to impose a negative deposit rates, the central bank hopes that banks will increase their lending to small and medium-sized businesses. The problem is in Europe is that we have no growth, and a lot of small and medium-sized businesses are still trying to deleverage. Okay, and also European governments has basically required the private sector to bear the brunt of what was essentially a public sector problem by increasing taxes. So you have a lot of small businesses that essentially have a lot of higher taxes imposed. They find that the government is not paying its bills. For example, in the case of Italy, to meet its 3% target, the Italian government basically hasn't been paying its bills. And this is one of the reasons that non-performing loans have been skyrocketing in Italy. So I find it highly unlikely that banks will increase their lending when the economic situation is so unstable. Now, when it comes to quantitative easing, you kind of wonder, given the fact that it's relatively been unsuccessful in both Japan and the United States and has created an enormous amount of unintended consequences, such as stock market, bond, or even real estate bubbles. Okay, the reality is that the ECB, I think, is panicking. Okay, they're basically realize that Europe is basically just a train wreck away from a breakup of the euro. So I think that this is unfortunate because the only thing the ECB will do is cause more price distortions. So it'll be that much more difficult to bring the European economy back onto the path that it needs to be to ensure growth and employment.
So the recent European elections showed a growing dissatisfaction with Europe and a growth in the eurosceptics movement. What is your take on this?
Well, if we look at the case of Greece, if we were to have an election today, the far left party would probably be the new government, and they've already indicated that they would default on their debt, and that's 240 billion euros, of which 50% has been guaranteed by France, Italy, and Spain. So again, for me, that could lead to a future financial crisis. I mean, we can't really expect the Greeks to be debt slaves, forever, okay? And that's basically what the European Union has imposed on Greece at the moment. And for me, that's just simply not going to happen. But also, we see these eurosceptics becoming more and more important in other countries, such as France, the UK, and other countries. And I think that's the reason is that Europe has gone beyond its initial mandate. Its initial mandate was for the free flow of labor and resources between countries, and what they've done is gone way beyond their mandate and started imposing restrictions on the private sector. And I think a lot of what you're seeing in the Eurosceptic movement is a revolt against all the restrictions that are being imposed by the European Union.
Frank, thank you so much for coming in and sharing your thoughts today. Really great hearing you.
You're welcome.
That's all we've got time for right now, but don't go away, as the Eurosceptic TV team will be back with another interview for you, bringing you all the latest in FX news and analysis. For now, though, it's goodbye.